FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.
Welcome. You are listening to the Financial Survival Network. I'm Kerry Lutz. It's 8/14/19. Well, market has been a bit of a wreck lately. Is this part of the future trend, the changing trend, or is it just a blip on the screen? Well, in addition to the market losing over 600 points today, you should know that gold is up $21.40 the ounce to $1522.30. Silver up over 2%, 36 cents to $17.28 on the bid. Sam McElroy is with us now. Hey, before I forget, KL@KerryLutz.com, KL@KerryLutz.com. That's the email address for your questions, comments, and for you to join the show. Sam, hey, so are we, is the long dreaded or long anticipated bear market with us, or is this just a blip due to trade tensions?
You know, I guess that's the $1 million question, isn't it? I've been of the mindset for some time now that while I saw a lot of things from an economic standpoint that I was very optimistic about, that I really liked, I still felt just in general that the market had some excess baggage that it needed to shed at some point. Not saying that I was rooting for a bear market or that it was inevitable just because we've been in a cyclical bull market for a period of time. I completely agree with the adage that bull markets don't die of old age. But I think that there have been some trends that have been emerging that have suggested that this natural biorhythm of moving back and forth between bulls and bears and moving from rapidly expanding economies into somewhat of a slowdown is something that was starting to emerge its head, and it's starting to present warning signals that it may be coming. Now, oftentimes, as we get closer towards an economic pullback, we see a lot of quote unquote shots across the bow. So we see a lot more volatility. We see things start to swing back and forth in terms of what's happening with the market. So when that started happening last year, I really started to pay attention to it, and especially as we're getting through a lot of this year in terms of what's happening. What tends to happen is that one of these times that the market starts to drop, rather than springing back like it has in the last few years, it may just continue to drop. It becomes a self-fulfilling prophecy in a lot of ways. So, people are talking around their kitchen tables that, this isn't going to go on forever. We know the market never goes up forever. At some point, it's going to start to slow down. And when they see stuff like this, my concern is that if there isn't some good news that the market can hang on to sometime soon, then people start to say, oh, okay, well, this must be it. And then they start to sell out. It pushes the market down further. And then it hyper accelerates the rate at which the market kind of hits that tipping point. And I don't know if that's what we're in right now, but it's certainly a possibility.
It is a possibility. It's kind of one of those things, isn't it, that we're not going to be there. We're not going to know we're there till we're there, right? Does that make sense?
That's right. That's right. Yeah. One of the things we always have to remember, especially when we're investing in the market, primarily looking for that capital appreciation, is that it's always backwards looking. We never know what's going to happen until it happens. So we're not going to know until we're deep into it that, because we've had a lot of other times, especially over the last, call it 6 to 12 months, where we've seen other 10% drops, but then the market comes back and we drop and the market comes back. So we just simply don't know at some point, is the market going to pop back the same way that it has the last few times, or is enough and we're going to continue on this downward slope? That's what we got to try to find out. Now, I have always been of the mindset that this is why people, based off of where they are, what their goals are, they have to be really mindful. It's the whole risk-reward trade-off. People who are retired or getting closer to retirement, they have to really start to consider how much they really want exposed to the market. They have to weigh whether, a potential 10% upside is worth potential 40 or 50% downside. For people that have much longer time horizons and that are younger, certainly it's never fun to ride that roller coaster, but they have less skin in the game, so to speak. It's not going to hurt them necessarily as much because they have time to recover. So they can maybe hang on a little bit longer to see what's going to happen, but maybe just have a certain price at which, if we dip below, they're going to start to pull out to some degree or something like that.
Mm-hmm. So So we're at a precarious moment. Last month's employment numbers were pretty good, weren't they?
Yeah, they were. It's an interesting kind of way of looking at it. I think that while everybody has their preferred or favorite metrics that they look at to try to judge what's going to happen from an economic standpoint, I think we're in an environment where any one data point doesn't really tell the story. So now we're looking at the convergence of data. And when we're talking about signals for a recession, there's anywhere from 4 to 10, I would say, major to somewhat minor signals that people start to look at. One of them is jobs numbers. So when you look at unemployment rates, typically unemployment signals good health for the job, for the economy. And we've had good job numbers, and that signal is basically telling us that there's nothing to worry about, everything is fine. When you look at some of the other signals, like the yield curve, while that is not suggesting that a recession is imminent, it definitely is suggesting that there may be some problems coming down the road. Other indicators like the ISM manufacturing index is starting to signal that there may be some rough roads ahead as well. You look at quits rates, you look at some of these other things, consumer confidence, and while none of these are saying, hit the panic button, everything is imminently falling tomorrow, they are more and more starting to suggest that something really may be brewing here.
Mm-hmm. Yeah, well, what about the so-called trade war with China? What is your take on that?
Well, I said, and I feel like this was probably sometime last year, that we knew there wasn't really going to be a neutral ground. This was either, it's kind of like a game of chicken. Either this was going to work and it was going to materially change the way that China engages in economic and global trade, and the U.S. was going to gain some advantages here, or it was going to be something detrimental that ended up hurting us. And we were waiting to figure out which it was going to be. There's enough data out there now to know that there is an impact. It's impacting China, it's impacting us, it's impacting other economies around the country. What we don't know is who's going to basically balk first. Now, as we're getting closer towards approaching deadlines, there's a lot more nervousness because it seems like neither side is willing to give. And I think that we always know that what the market hates more than anything is uncertainty. So I think the longer we remain kind of waiting and guessing to see what's going to happen, and the more it looks like something positive may not come from it, that gives the environment for fear to creep in. And if consumer confidence falls, especially if they start to feel it, going out to the stores or bidding on jobs or whatever else it might be, if they can start to let these fears that are starting to creep into their mind be rationalized by real experiences they're having, I think we could see not only an economic reason for there to be a slowdown, but an emotional reason for people to start to question the strength of the economy as well.
Wow. So, but as far as Joe Sixpack goes, Joe Sixpack's doing better than he's done in years, isn't he?
FSN Radio. It's all about what's next.
Trilogy Metals is a world-class developer in Alaska's Ambler mining district. The company already possesses 8 billion pounds of copper, 3 billion pounds of zinc, over 1 million gold-equivalent ounces, and now over 77 million pounds of cobalt. Trilogy's Arctic project boasts an after-tax net present value of $1.4 billion with a 33% IRR. Trilogy is led by an experienced management team with proven success in discovering and developing projects in Alaska. The company is well capitalized, has no debt, and possesses strong institutional support. Trilogy trades on the New York and Toronto exchanges under the ticker symbol TMQ. To learn more, go to trilogymetals.com. That's trilogymetals.com.
The Financial Survival Network. It's all about what's next.
I'm not sure.
Yeah.
I'm not sure. When I look around, it depends on which Joe Sixpack may be. I have had a lot of conversations with people that are just, everyday, hardworking individuals that are telling me that they're working multiple jobs, or they've had to do a number of other things to be able to make it work. That it wasn't that they were lifted out of the situation they were in because they were getting raises or better opportunities and stuff like that. I look at one of the things I look at frequently is the average wages. And average wages, from my estimation, even though we've seen a little bit of an uptick, are really stagnant. I'm looking at inflation, and inflation has been kind of stagnant. So in terms of looking at the average worker and saying, well, gee, aren't you much better off now than you were before? Well, certainly many of them were hurting when we were in the midst of the last recession we had. But going back from, let's say, the last decade, maybe from 2000, maybe a little bit further, let's say 2002 to where we are now, wages have really been about the same that they've always been. So I don't know that people really are doing a whole lot better.
Well, they restated those wage increases, said they were somewhere last year over 5%, the year before that over 4%, and this year so far over 5%. So maybe it's better than we thought.
Yeah, maybe it is. It's hard because it's subjective in a sense also. We have some data like average wages that we can look at, compare that to CPI or some other data points like that. And then we have the subjective feel of what people are reporting to us also. And so some of it might be my own subjective feel that just in talking to a lot of the people that we work with and people that are coming in to see us, it doesn't seem like, I'll say it this way, I haven't had anybody come in the office and say, gee, I'm so happy, I'm doing fantastic, and I was, horrible a couple of years ago. And maybe it's the subset of people that are coming in to see us, but
right.
It's hard to tell.
Mm-hmm. Little hard to quantify. It seems, though, that jobs are plentiful. Whether they're paying enough or not, we don't know. Obviously, some are not, but there are higher paying jobs out there that have lifted people up to some extent. Small business creations picked up a bit. Labor participation rate picked up a bit. So there is a little bit of upside on these numbers, and certainly corporate profits have gone way up, and some of those profits have been shared to some extent with the employees. So I just wonder if this can go on further. I've perhaps been skeptical at times, but as of late, I just said this thing is going to keep going on until it stops. A trend in motion, right? Stays in motion until it doesn't anymore.
Yeah.
So
that's right. And I think all of us collectively, as participants in this country, want to see everybody else continue to do better, want to see the country as a whole and the economy as a whole continue to do better. We want to remain the country that other countries look to see, how to do it, so to speak. I think that's what we all want. So we're all rooting for that to continue to manifest. I think that there's two pieces, though, which is one, I certainly don't want to see us go back into a recession like the last recession that we had. And we know that there was a lot of extenuating circumstances that put a lot of pressure on our economic system. But I also think that we need to be really mindful that we don't fear cyclical bull markets or minor recessions or something like that, as they have always occurred. It's part of just the economic process of expansion and pulling back. Mm-hmm. And one of the things we need to be mindful of is that out of fear for experiencing some of these natural drawbacks, we don't try to manipulate the system too much, because I think that there's a lot of history that suggests that the extent to which we manipulate our economy, we end up creating bubbles where we didn't mean to. We end up creating other ripple effects where maybe we didn't really mean to, and potentially not even delaying the inevitable, but just postponing it slightly and making it somewhat worse than what it might have been had it naturally run its course.
All right. Well, I can buy that. And so we're just at a very uncertain time, and it could go either way. We don't know where it's going to go yet. So what are you telling your clients, Sam? What advice are you giving them?
Well, yeah, our philosophy has always been pretty consistent, which is when people are in or around retirement, we prefer to help them structure their asset income in a way where much of their withdrawal needs can really be satisfied through dividends and interest, so that it's not dependent on market appreciation or depreciation for what they're going to live off of to pay bills and travel and do other things. Just by being able to have better purpose around how people are allocated and how they're utilizing their investments, they can mitigate a lot of the risks that they don't have, that are existing in the stock market. Because really the main risk, especially when you talk about somebody who's retired, is that sequence of return risk, which deals with the order that the return happens. It's just unknowable. So people are really relying on statistical, probabilities and stuff like that. For people that are a little bit younger, then it's really going back towards that risk tolerance. So understanding that over the long run, the stock market has always been a really good source, really outperformed in pretty much every other asset class, but utilizing it in the right place. And I think that it's also important for people to understand that the stock market is a tool for investing. It's not free money. So I think people sometimes underestimate the amount of risk that can be in investment strategies. And I think just having a clear mind of what your objective is, what your purpose is, how much risk you're willing to take, it puts you in the driver's seat to be able to own your decisions and own kind of the eventual outcome of where it comes.
Yeah, I agree with you there. Hey, exciting times, interesting times for sure. Well, I guess we're just going to have to see what happens next here. Sam, just tell us, where do we find you these days?
Yeah, so easiest place is on our website. It's just www.atfinancial.com.
All right. Hey, there's a link to it in the show notes. As always, email address for questions, comments, and feedback is kl@kerrylutz.com, Twitter feed @kerrylutz, Facebook page, Financial Survival Network. Sam, we'll talk to you again real soon. Thanks for checking in.
Yeah, thanks for having me.
FSN Radio. It's all about what's next. Go to financialsurvivalnetwork.com and sign up for your free weekly newsletter. You'll also get 3 free reports. The Financial Survival Network. It's all about what's next.